Welcome to the Daily Update Executive Summary. This is being prepared Thursday, June 9th, where we'll look at the action in the market today and then see how things look for Friday, June 10th. Initial feedback that I received on this newer format seems to be quite positive. The idea is that I do these shorter videos where I'm just hitting charts and talking about things that are actually happening. Then 1 or 2 times a week, I go back and I go through all of the different charts that we look at just to evaluate where things are at. So let's go back and look through the notes about what happened on Thursday. All 11 sectors ended up being down. It was a negative day on Thursday. The VIX of the VIX, and the Vixen all rose. The Elder Impulse for the S&P, SPY, Diamonds, and Qs has turned negative across the board. So we're looking at broad-based negativity right now based on that system. There was broad-based selling. Both growth and value ended up declining on Thursday. The 2-year spike that we're looking to see if we can get some insight, it's not giving us a signal right now. Stocks were down, interest rates were up. It's going kind of in the opposite direction of what we want to see for a positive signal. The staples, it still remains viable. Even though stocks were down, staples were down too. And so that spike still looks like it's giving us a legitimate signal. We're just not seeing a follow through with price. Gas is still going up and up and up. The US dollar has been showing some recent strength as stocks have been going down and having some weakness lately, plus news that came out of the European Union that has helped strengthen the dollar over the last couple of days. Gold is still above its 200-day moving average. The small caps declined below support. Mid caps, the Dow, NASDAQ 100, and the Wilshire all dropped below their monthly pivot. The 10 to the 5, it's now inverted again. We have the 5-year yield higher than the 10-year yield. The European Central Bank did not end up raising interest rates as had been speculated, but they did signal that, all right, we're going to go ahead and probably in July raise them 0.25%. We might even go further than that as we go throughout the summer into September and even after that. Another thing that they said is they're going to end their European version of quantitative easing starting in July. They also projected up their inflation rate to 6.8% in 2022. It had been 5.1%. And in 2023, they said inflation was going to be 2.1%. Well, now they say it's going to be closer to 3.5%. In the US, we did have jobless claims that came out, and they increased to 229,000. That's stronger than the expected reading of 208,000. What are some of the notes that we can take just from the S&P itself? We were down 2.38% on below average volume, which seems to be the real story these days. The equity put call ratio on a daily basis as well as on a 5-period basis moved higher. Prices are starting to fall below that short-term rainbow chart, and because it's in blue, I'll show you a chart of that. The S&P did lose that longer-term support level. The moving average studies that we look at are showing weakness. The advanced decline line is also showing weakness. The STO is weakening. Advanced decline ratio, all these things are really looking weaker right now. There was a lot of technical damage done. The S&P ended up falling below the 20-period moving averages that we've been watching. The rate of change based on 1, 5, and 50 periods are extreme negative. The McClellan oscillator as well as the Summation index are also negative now. The momentum is still positive with our oscillators, but especially some of the short-term oscillators, they're starting to roll over. Our more intermediate term and longer term oscillators are still holding up, but if we see more weakness, they could start to roll over as well. The stop and reverse system is still positive. The dots are still underneath. The stochastics are no longer extreme and negative, and I have a chart that I'll show you. The long-term moving average study is showing weakness with the 50, 150, and 200 days. New highs and new lows are still positive, but showing weakness. The force index has switched from positive to negative, as has the ultimate oscillator. Heiken Ashi and Kegi have switched over to a negative stance. We're dropping below the short-term Fibonacci level at 40.20, roughly. I rounded up on that one. The percent B with the Bollinger Bands, the RSI 19 period and 14 period have also turned negative. All of these dropping below their midpoint, so they're having a strong negative bias now. The advanced decline line, based on 1 day, is extreme negative because we had a pretty solid down day. The price momentum oscillator studies are starting to turn more negative, and I'll show you that. The S&P ended up dropping below last week's low. That had been a short-term level of support. Well, we lost that on Thursday. As far as our trend, we are negative. We're below 20, so we're not trending. The bias is negative, and the momentum is now switched to negative. Basically, what we need is a real strong up day on Friday. We've got the CPI coming out. That's going to be huge. If that surprises the markets in a positive way, that could help repair the technical damage. If it's in line with what people are thinking, or even more negative than expected, then we could see some further damage from here, and a lot of the positive scenarios that we've been seeing could start to go away. Right now, fear is at 32. We are still fearful, but not extreme. Gas just goes up and up and up. It's at $4.28 now in the futures market, which probably means $25 a gallon or something at the pump. Here's a couple of headlines that I saw as I was looking through some different periodicals. In Barron's, it said the stock market used to have a friend in the Fed. Now it has a problem. Another article talked about what's going on in Europe, where the ECB, the European Central Bank, plans July rate increase as inflation problems deepen. Some other charts from Isabel Net. This shows analysts expect a flattish margin in the first quarter. Even though we're in the second quarter now, they're reporting what has happened in the first quarter. This is similar to what we usually see. But the record high margins are still expected for the second through the fourth quarter. Where we are at right now is this first yellow bar, and that's what's starting to come out now. That's pretty much what it's been in the past. What they're still quite optimistic about is 2, 3, and 4, these other yellow bars right here. Another chart should not be a surprise to those that watch these videos on a regular basis. It just shows how energy is really outperforming the S&P. This is a weekly chart. The problem that I have with this and with any chart that draws arrows before things happen, I don't like that. The doom and gloomer Elliott Wave folks, they're always drawing arrows. And you know, before you even look at the chart, for stocks, it's going to be a down arrow. For gold, it's going to be an up arrow. And they've been doing that for decades. My problem when people draw arrows like this is what you fixate on. You're not fixating on what the chart is actually saying. And so that's why I have a little bit of a problem with that. Yeah, energy has been doing well, but we don't know. Everything could change. Another thing is household equity. People are still in the stock market, whether they have their own portfolio or an IRA or they're some kind of a retirement plan on their own, but it is coming down. As the market comes down, we see equity allocations start to come down as well. This just shows the S&P 500 earnings revision breadth over a period of time and how it's correlated to an inverse chart of the dollar. So as earnings start to come down, we are seeing the dollar, really it's going up, but they've inverted this chart. They tend to have a pretty strong inverse relationship with each other, earnings and the dollar. And if you think about it, it's true. And it's why I say a strengthening dollar can inhibit the stock market and a weakening dollar can help it. Looking at the year-over-year PMIs against the year-over-year S&P, we can see how they move really hand in hand with each other. And in 2022, we've seen PMIs really declining. That's purchasing managers' indexes. And we've seen the S&P, of course, really declining as of late. So if we want to see some strength in the market, we're going to have to see some economic strength in the PMI readings. Another thing that was presented in this chart is, if you recall, President Trump put a lot of tariffs, especially on China, because of what he perceived as being unfair trade balances. Well, this is suggesting if maybe we took away some of those tariffs, that might help inflation. Another thing we can look at are that call volumes have really come down. When the market goes down, people tend to get into puts. They increase in volume as the market goes down, or they're used as protection. When the market's going up, people buy calls. They increase in value as a security or an index goes up. This blue line is just showing how calls have really been decreasing in volume, where the puts, they've been decreasing as well, since folks may end up doing a lot of covered call writing. People tend to understand buy low and sell high better. There tends to be a lot more calls than puts in the daily volume. And even though we're not seeing a real spike up in puts, we're seeing a real decline in call volume. This shows the 10-year and market depth, just how many contracts are out there in the futures market. When interest rates are going up, this has a tendency to really go down. We also had the Active Asset Manager Survey released, and they're back up to 50 right now. It was released on the 8th. That's more neutral territory, although at some points, when we're going really well, this would still be extreme negative. But in 2022, we're coming off where they even dropped below 20 there for a while. So this is showing some more improvement and probably back into the more neutral category. And then you can compare that with the S&P 500 down below. We had the AAII survey come out. They're starting to get extreme negative again, which could be positive for the markets. Here, I went to their website, and it just says, out of the people that took this survey, 21% were bullish, 46.9% were bearish, and 32.1% were neutral. We tend to throw out the neutral reading and then read the difference between the bullish and the bearish. So now that gives us a minus 26. They round it up. And they're saying that this is more in the greedy section, where we would look at this the opposite way. I'm seeing this more as fear over here, and then it's more greedy when we get over to the right-hand side, but they just have it flip-flopped. Let's go back and look at the day. We did gap lower at the open. We gapped down to S1. We were able to get back up to the unchanged level, and that was the high for the day. We dropped down below S1 and danced along that level for quite a while. Tried to come back up a little bit, and it looked like, all right, another sleepy day. We're just going to tread sideways. Well, as we got into the depths of the day, we saw selling take us down to S2, and then we just kind of fell apart altogether. And we ended up closing right at the low of the session, setting a new low for the week, really damaging our technical charts quite a bit. A lot of the positive things are now in danger of going away. Here's the daily chart, which shows how we dropped down below the longer term support. We dropped down below the pivot. Now we have to see, can we hit some of these other pivot levels from days gone by, or are we going to head all the way down to S1? If we hit that level, then we may go back and test the May low. We're also seeing down on the bottom how volume did increase slightly, but it's still way below average. The ADX is turning more decidedly negative, where we're still below 20, so there's really no trend right now, but the red line has spiked up. The green line, which is very hard to see here, has been going down. So no trend, but with a strong negative bias. We dropped below the 20-period moving averages, both the simple and the exponential. The rate of change based on 5 periods is extreme, but it could go even further. Short-term stochastics are starting to come off that extreme overbought signal that we've been getting. They're coming down in the intermediate term. They're still going up in the long term, but could be beginning to roll over. The STO, which had been giving us some positive signals, well, they went the other way, both based on price and volume. They're now decidedly negative. We're getting to the lower end of our rainbow for the short-term rainbow based on the 10, 20, 30, 40, 50 simple moving averages. Based on one day, we kind of overdid it with the advanced decline ratio. Our advanced decline chart, which we had been working off at this positive divergence, well, that seems to be in jeopardy right now. It's still in play, Thursday's decline really did a lot of damage. We had been in this range up here, and now we just dropped below it. We have been in this area before, but it was kind of hoped, looking at what we were seeing on our charts, that we might be establishing a base before we get set to go higher. Well, just the opposite happened. We saw a real decline based on price and volume. We've dropped below the moving average on price, and we saw another decline based on volume. The advanced decline ratio has also dropped below 0. McClellan oscillator has now turned negative. The PMO study was giving us an extreme positive reading there for a while. It's now dropping negative, as is the percent of buy signals. And the PMOs above 0 is starting to roll over. Force index had been positive but declining. Now it's switched over to being negative. Ultimate oscillator dropped below 50, so that is negative. The summation index has turned down based on price and volume. Rate of change, 50 periods, is giving us an extreme negative reading. Heiken Ashi has turned to a dark candle now. That's negative. The Kegi has also turned negative and showing a red bar now. The Elder Impulse system is negative for the SPX and the SPY. The Go-No-Go system has switched back to a dark purple, so that is negative. We've dropped below the fib level. This 50% level is at about 40.19 to 40.20. Well, we closed at 40.17, almost 40.18 on Thursday. So we could be losing this support. The TTM squeeze is also coming back down to the anchored moving average. This is a solid blue. It's still positive, but this solid part has turned it more negative. When these lines are lighter color, that's more positive. When they're darker color, that's more negative, or showing a sign of exhaustion, which is kind of the opposite of what you might think it would be. We dropped below support with the mid caps, down below the pivot, so that's looking more negative. The NASDAQ also dropped well below the pivot. Now, it had been going up and down around the pivot. Well, now it's more decidedly below it. The Wilshire has also dropped down through what had been support. The diamonds are negative, as are the Qs. The dollar was up 0.2% on Thursday, so maybe we're getting a bit of a bounce now. We might be doing this at Stoch's expense. When the dollar was really coming down, that's when we were seeing some improvement in the stock market. Now that the dollar is going back up, that might add some more weakness to stocks, because this is what we're looking at. As I've been pointing out a number of times, when we've spiked and gone down before, that usually happened after major events. May of this year, did anything major happen? Not really. This was COVID-19. This was the election as well as Brexit. This was China devaluating their currency. Was there anything really that major to cause a spike right now? I don't think so. Oil just continues to go to the moon. Even though we declined, we're at 121.51. Again, we're looking at other times where major things have happened that also marked a spike in oil. What is the story for 2022 other than bad news? There doesn't seem to be one individual catalyst. You could point to the Russia-Ukraine war. You could point to the supply chain issues. You could point to the U.S. economy. But these things tend to suggest some kind of a historical event that may not all happen at once, but you can look back in the future and give this some kind of a label. Like we go back and we talk about the financial crisis in 2008. Is that what scenario is developing right now? And if we're not developing that scenario, this could even go higher. Looking at our interest rate, really nothing changed here. In fact, it turned more negative. Again, what I'm trying to look at is why is there such a big difference between where interest rates are at in the 2-year and where the current Fed funds rate is at. And here's an updated chart to show you. We're seeing a negative correlation right now. So interest rates are going up and stocks are going down. So that's why we saw the decline in this value. Here is the 10 to the 5 yield curve, just showing that we're at minus 0.03 currently. Our possible positive scenarios. This doesn't look viable right now. When we look at the 2-year Treasury yield, it's still going up. And so it could continue to go higher than where it's been recently. The small cap index, this seems to be breaking down as well. We dropped below the moving average with the small cap index, but we're still above the daily pivot. Here's the ratio between small caps and the S&P 500 where it did actually go up almost 0.5%. So when we're looking at this little spike, see how it's come down slightly. We want to see this spike up and then within a few days see the S&P take off after that. Did we get the spike here? Will Friday be positive? Will it really shoot prices higher? We don't know that yet. We just want to be open to that in case it happens. Looking at the staples, they were down 1.5%. So there was a lot of weakness in that category. And so this is helping to show that, yeah, this looks like a valid spike here with the staples. But look at what price is doing. We're not seeing a real follow through. Now, don't be disheartened completely. Other times we had this didn't mean we went straight up from here. We fight a wall of worry every time these things happen because these signals are generally given to us when the exact opposite is what our emotions are telling us. So we just want to keep an eye on this and see if this turns into anything legitimate. The other thing that possibly could happen is somehow staples get a fire under them, come back up, take out this spike that we're dealing with now as stocks continue to go down. But we're not seeing that yet on this chart. Our technical overview, those things that were positive continue to be positive. So there's been no changes here. Those things that are negative continue to be negative. I just rattle off the list here. And it keeps going and going. All right, so what's our outlook for Friday? Our technicals are weakening. Thursday did a lot of damage. Sentiment is still negative, but not necessarily extreme negative. The growth and value battle, they both lost. On Thursday, economic reports, we have the big one, the CPI coming out, and then later in the session, consumer sentiment. We'll get the preliminary reading for that. Later in the day, we'll get the Treasury budget, which is not a big shaker unless it's totally crazy. Different geopolitical events. Russia, Ukraine, could be positive or negative. China, I saw something where they might be locking down part of Shanghai again. That could freak things out as well. Inflation and interest rates, which are producing growth concerns, that's what U.S. investors are focused on. Oil continues to shoot to the moon. We have earnings as they come out. There's really not any Fed speak that we can look at right now. If anything, it's turning more hawkish. And then the longer term scenario in Japan, which I really haven't dealt with in quite a while. So our scenarios, down. All the things that I just mentioned. And if we continue to see the 2-year going up, that's going to help stocks go down. The technicals are showing some weakness. Positive, we need a lot of things to happen for things to get better again. So I just say, yeah, they need to improve. Sentiment is negative, and there's a real disbelief right now that the market is capable of going higher. Sometimes that's when it happens. The possible positive scenarios, we're still having valid signals from the Kopit curve, the Pring bottom fissure. The staples are looking good. The mass index gave us a signal. 2-year yields have not topped. And the Fed pivot, they're turning more hawkish, if anything, rather than more dovish. So some of these are positive and some of these are looking actually more negative. The technicals not really giving us much help right now other than possibly daily pivot levels, some fib retracement levels that we might hit either in the S&P or in other indexes. Previous high lows or pivot levels, they may provide some kind of support if we continue to fall. They also may provide resistance if we advance. This is the current scenario. We are sideways because the ADX is below 20. The red line's on top, so it has a negative bias. So our conclusion then is the S&P is negative. Short-term negative, intermediate term negative, long-term negative. You really can't see too much positive in the market right now other than it's not falling apart completely on one hand. On the other hand, we're not extreme negative on a lot of our indicators either. So this might have more room to fall if that ends up happening. So thank you. I hope you have a really wonderful Friday. Please let me know what you think of this new format. I did get some really good feedback on this. People seem to like this. So just let me know what you think, or if there are charts that I'm not showing that I should show, or charts that I am showing that I really don't need to show. Let me know what you think of that, and I will prepare the next video after Friday's session as soon as I'm able to get the updates for that.